Hello from the Dukascopy TV studio in Geneva. I'm Daniel Schwenger. We are discussing the key investment drivers for 2015, how to maximize your resources and to minimize your risk. Today with Mr. Allan Maksymec from Strategic Asset Management SA here in Geneva. Allan, welcome to the studio.
Thank you, Daniel. Happy New Year.
Thank you to you as well. So what are actually the strategic and key investment drivers for 2015 to pay attention to?
Sure. So we think that 2015 is going to be quite a bit different from 2014. In 2014, U.S. equities outperformed, U.S. dollar outperformed, cyclical sectors and technology, biotech, these all did very well. Those were all calls that we made January, basically at this time. And they ended up the year 10% up on the US dollar, 11% on the S&P, 20% on technology, and about 30% on biotech. So we had a very good year. This year, we expect a different year, which is economic divergence and increased volatility. So as the Fed has ended their quantitative easing program, that was kind of a backstop that a lot of institutions and investors were counting on. Now it's not there anymore. You can expect more volatility out of that. So basically, the things causing the divergences this year will be central bank policy divergence, those that are tightening, which is like the US, versus those that are loosening still, which is like the Eurozone and Japan. The second driver would be the net beneficiaries of cheaper oil versus the net casualties. This is something that's formed in the last 2 quarters, and now it's at quite severe levels with oil down 50%. That's a very short period of time to lose 50%. And then finally, correlations and valuations of asset classes have been diverging, which is a sign of things actually getting back to normal. Which is something that we were looking for. During the crisis, you might remember it was risk on, risk off, and everything either got sold off or got bought at the same time. That wasn't normal. Now we're getting into more of a normal cycle where you actually see valuations in certain equities will change, bonds, all these things are moving around. So it's going to be a challenging year.
So you mentioned now these 3 key investment factors. So actually, how should investors strategically manage their portfolios to maximize their returns?
Sure. Well, it's not going to be easy. Let's put it that way. First of all, I think the first key is to be selective. Not all stocks are going to do well this year. Those that have reasonable valuations still, strong balance sheets, and revenue growth rather than just profit growth, but we're looking for actual revenue growth, growing their businesses, are going to be important. Investors shouldn't try and time the markets. We think that there's going to be no crystal ball for when a major correction happens. We expect, a correction to probably happen in 2015. Could be, up to 10%, let's say. And that's because we've had more than 1,000 days now of uninterrupted gains without a major correction of 10% or more in the markets. And that's about the 5th longest correction-free rally since 1928. So it's not out of the, completely off the charts in terms of being abnormal, but it's really getting to a very long rally now. And I think, people have to stop and think. And we think that when the Fed tightens, that will sometime around that period, either in advance or after, or right when it happens, there's going to be a sell-off.
So there is also some risk in the markets in 2015. When there are opportunities, there are obviously also some risks. So how do you actually leverage risk? And what tactical investment methods are you using in 2015?
Sure. So, I think the best that one can do is to, maintain their diversification. Don't concentrate your allocations in just one geography. I mean, last year the U.S. did spectacularly. Most of the rest of the world was mixed to poor. The US dollar was up against everything else pretty much, between 10 and more percent. But don't count on that just going on a linear fashion up. So still have some European equities, still have some select Swiss equities. Don't count on just one sector to carry everything. Healthcare we like, biotech we still like, but it's getting a little overvalued. Obviously oil, if you had a heavy concentration in oil, it's not a good year for you, and it wasn't a good year last year either. And we think that weaker oil price will continue for some time, probably longer than people expect, which isn't good news for those commodity dependent producers such as Canada, Norway, Eastern Europe, Russia, in other words, Mexico. They're going to have a tough year this year, and those should be probably underweighted. So yeah, I think our message is don't be swayed and complacent by just one geography. I mean, the States has been a great driver of growth in people's portfolios, but don't be complacent that that's just going to continue throughout 2015.
Allan Maksymec from Strategic Asset Management SA here in Geneva. Thank you so much for sharing your expertise with us today.
My pleasure. Thank you.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.